For most of you, you're taking out the minimum amount out of your RRIF account in retirement, but the reality is you're paying more taxes because of it. And I covered this in a video a couple weeks ago, and a lot of you reach out asking, can we see more detail around that? So I want to share our software and break down why taking the minimum amount out of your RRIF account, your retirement income fund account, probably doesn't make sense for you. Once you hit retirement, you convert your RSP to a RRIF account and you start drawing it out. Now, every year you have to take out a minimum amount, and that's based off the account value of your RRIF and a percentage based on your age. And I won't go into that into this video, but for a lot of you, you take out the minimum amount. In fact, most people take out the minimum amount and no more than that out of your RRIF account, but you should probably be taking more. And so some of the flaws I'm going to highlight here, the three key ones that are costing you a lot of money. And the first one is you're paying more taxes. So here's a scenario where the client is 65, has retired, and is drawing out the minimum amount. If I hover over this, our software will show the minimum amount, $23,077. And they continue to do that for the rest of their retirement plan. Now again, key number one is you're paying more tax. So in this strategy, again, we've left the income, if you remember from our last video, the income, 60,000, 55, and then 48 for the go-go, slow-go, no-go phase of retirement. And they have this travel budget. So all of that's the same. They have $19,000 left in their accounts at the end of the day. It's all in their RSP. If I scroll down, you can see that. Now, let's look at the total tax they're paying. So if I click on the total tax bill here, we can see they're paying $295,000 of taxes. So problem number one is they're paying a lot of tax. Can we minimize that? So by taking the minimum amount out of your RRIF account, this client's paying $295,000 of tax. Now, if we didn't take the minimum, if we took a bit more than that, what does it look like? So we've taken a scenario here where we do what we call the RSP meltdown, but we're taking more than the minimum amount. So instead of just over 23, we're taking 55,000. You might think, Adam, that's a lot more tax you have to pay. But when we look at the total tax bill, guess what? It's now dropped. This is total tax payable from age 65 to age 90. They're paying $270,000 of taxes. So they've now saved $25,000 of tax by not taking out just the minimum amount of taxes. The second tax issue here is your effective or your average tax rate. You can see here, in the first few years, they're paying about 10 or 11% of tax. Then it jumps to 14, then 19, and then levels out around 15%. So it's a bit of a roller coaster of tax situation, and that's one of the reasons they're paying more tax. There's no leveling there. The other tax issue, the third tax issue on here, so they've paid more tax. It's more of a roller coaster, which is not ideal because you're not paying similar tax every year, which in retirement brings peace and comfort and lower tax bill. But also you can see on the far right, their tax on estate. You can see they have an estate tax all the way till the day they die at age 90. You can even see in their early 80s, they still own $100,000 to $200,000 of tax on death. So again, not a good situation around the tax. And we see this quite often when people come to us. They've been retired for a few years and they're just taking that minimum amount out of their RRIF account. And it causes issues like this. You're paying more tax, you're melting out in other accounts you shouldn't be, which I'll touch on here in a second. You're creating a worse estate planning situation. Like, we all want to give CRA less money, not more. And there's ways to do it. And taking out the minimum RRIF, you can see here, probably not the best idea. The second problem when you take out the minimum RRIF account is you're creating a bad estate situation. And I showed you there, you still have a fair amount of tax, but let's dive into it even deeper. So if this client, let's just grab a couple ages. So age 85, if they passed away at age 85, you can see up on the screen here on the very top left-hand side, at age 85, their estate after tax would be $95,000, meaning that if they passed away, they paid the tax, which is about $100,000, their beneficiaries will be left with about $95,000 in today's dollars in their pocket. Now, if we go to the RSP meltdown where we're taking out more than the minimum, and we go to age 85 and look at the same situation, you can see that instead of $95,000, they have now $123,066. So much more income or much more assets to their name. So yes, they've drawn down their accounts quicker, but there's still more left in the estate. The question now, and a lot of you are asking is, okay, but Adam, what happens if they die at 75? Like, if you take out more than the minimum amount, you're drawing down your accounts a lot quicker, meaning that if you die earlier and you haven't taken your CPP and you've drawn down your accounts, your estate's going to get less. And I've worked hard for my money. I want to make sure if I die, I've spent the government money and not my own. But again, the reality is that for a lot of you, it still works out better. So let's jump into that. So back to the minimum RRIF withdrawal. And if we scroll down to age 75, so let's say, you know what? In this situation, I've taken my CPP early. I'm spending the government money. I'm taking the least amount out of mine as possible so that if I die early, my estate gets more. So sure, if you passed away at age 75, there's $605,000 left in your accounts total. You are about $300,000 in tax, and there's $307,000 left in your estate. And in today's dollars, it's equivalent to $239. Now, if we look at the same scenario, but again, we've delayed the CPP to allow for this RSP meltdown. So we're not taking the RRIF minimum anymore, we're taking out more. If we jump to age 75 here, we can see there's less money. So we had 600,000, there's now only 478, but the tax bill is cut in half as well, meaning that we have $328,000 to give to our beneficiaries. So more than before. So if we compare it to the other one, we're at 328 versus 307, and in today's dollars, 256 versus 239. So we've given our loved ones about $15,000, $20,000 more in today's dollars. So again, the point isn't really how much. It's not a lot of money, $15,000. Everyone would like that though. Whether you have a lot of money or little money, $15,000 is still $15,000 in today's dollars. So it's a lot of money, but the point is, even drawing down your accounts heavier, it's creating a better tax situation. Even in this case, at age 75, it's better, and age 85, it's better. Even though there's typically things like this that make a lot of sense, based on your needs, the way your assets are structured, it may not make sense for you. Again, you might be that 1%, and that's okay. But you want to run through and figure out exactly where should my income come from, how much, when. Again, you have taxable and non-taxable income. There's a lot of moving parts here. And for a lot of you, you walk into retirement and you just take that minimum amount, you start your government pensions, you do things backwards. And at the same time, you're saying, well, I want to pay CRA as little as possible. But you're not. You're actually paying them as much as possibly can. So sit down with a financial planner. Again, we're happy to do that with you and map out a better strategy to put more money back in your pocket. The third problem with drawing just a minimum RRIF account is flexibility. In retirement, we want to pay less tax, we want more income, but we want it to be stress-free. And if all of our accounts are running low other than registered accounts, taxable accounts, it creates a lot of stress. So you can see here, when we do just a minimum RRIF amount, we're leaning heavy in the first 3 and a bit years on that non-registered account. So that's going to be depleted. That's a $100,000 account that's depleted within 4 years. We're then leaning on the tax-free savings account for this client. Again, they have a $60,000 income need plus that travel expense. So by the time they're 75, the only account they have left to draw on is their RRIF account. And so you can see, first off, that at age 75, their tax bill goes way up because they need the income and they have to drive out $81,000 out of the RRIF account. But what happens at age 78, 80, if they have, an emergency, new roof, new furnace, healthcare bill, whatever it is, new car? They have to draw that money from the RRIF, which creates more taxable income, which is not a good situation to leave yourself in. Now, if we look at an option of not taking the RRIF minimum and actually doing an RSP meltdown and taking more and creating tax strategy, you can see here, and I showed you before, we're paying less tax in this situation. We have more money at end of life. We have a better estate plan, but we also have that flexibility we're looking for. You can see the non-registered account now is depleted, but it's depleted over about 6.5 years. Then the TFSA, we're drawing on, but we're actually not using all the TFSA for our life. You can see at age 90, there's still $79,000 left in there. So at age 78, if you had an emergency, you can see there's $165,000 in your TFSA account. So if you had a $10,000 new furnace you had to put in, guess what? You can pull that money from your TFSA and not drive up your tax bill. There's a lot of flexibility there. So when you do just a minimum amount, it puts more heavy lifting on your TFSA, on your non-registered accounts, to draw more money out of there to get you the income that you need. Thus, those accounts are getting depleted faster, meaning that later in life, in your 70s and 80s, those accounts may not be there anymore. And that creates a situation where if you have an emergency, if you have a big expense, you need to pull that money out of your RRIF account, and it's all going to be taxable. Whereas doing the RSP meltdown, not taking that minimum RRIF account, It allows you to extend those accounts further. Gives you that flexibility, that peace of mind. And trust me, I've worked with retirees for 20 years. It's a big difference. It allows them to sleep better at night. They have that peace of mind. It's a much better plan. So not only are you having more income, more assets at end of life, paying less tax to the government, but you're creating more flexibility and more peace of mind, which brings comfort to you through retirement. And again, retirement should be enjoyable. And for a lot of you, it's very stressful. I talked to someone the other day, and they said, Adam, we've been watching your videos for about a year and a half now. We've gotten a lot of content, a lot of knowledge. The problem was we're located in Saskatchewan. You're located in BC. Now, we have staff in BC, Alberta, and Ontario, but we help everyone coast to coast. Now, this person wanted to deal with someone locally. So they said, you know what, Adam, we want to reach out to you and work with your team, but we thought we'd find someone local. And so they ended up hiring someone locally about 8 months ago. And I had a chat with them the other day, and it's been an absolute nightmare. So, sure, look for someone local, but you want to find the best person for your planning. It might be our team, it might not be. But give us a call. We'd love to chat through it with you and figure out, can we help put you in a better situation in retirement? Yes, there's a cost to our service, but there's a huge net benefit. And I tell everyone I have a call with, and this is really important. People come into our service. When they hire us, it's, okay, I paid X amount for a plan. What's my ROI? And by the way, our prices are right on our website. So very transparent. Go check it out, parallelwealth.com/planning. So I've paid $4,000 for a household plan. Am I going to get my $4,000 back? And you can see here, yes, you are, and many times over. But people walk in with that mentality, and I would too. It's an investment. I've paid money for this. Am I going to get my money back out of it? But let me tell you, 100% of our clients, and we've done thousands of plans, 100% of our clients walk away from the process, not, okay, I got my money back out of it. It's, yeah, that for sure I got that. But they walk away from the process with, I have a clear plan. I have a direction. I know what I need to do. I know where my income comes from. I know how to reduce my tax bill. I know how to, how much I can spend in the go-go phase and still be okay for the no-go phase. It's all the strategy and the GPS roadmap that they have. That's where the value is. So if you're walking into, or maybe you're already in retirement and you're like, I don't know if I'm doing the right thing, you're probably not. The reality is you're probably not. I've done this long enough to know that. So loop in with our office. We'd love to help you out. We want to walk you through this process to make sure that every single hard-earned dollar that you've saved up to this point is best used and that you're using it and not CRA.